movement away from the bank. I've been in the startup ecosystem. I have invested individually now, and then I was part of a couple of accelerator programs, and now I'm part of San Angels. Working with startups and figuring out how we can invest in these startups.
Hi, I'm Sanjay Shukla, and I'm also co-founder for San Angels. And primarily, our objective is to work with the first-time angel investors, either in India or abroad, and help in Indian startup ecosystem. So we try to get the best startup, which is people can rely on, and then they can invest in. My background is I am also from a technical investment banking background. Since 2012, I am also in the startup ecosystem, been part of several angel networks and then incubator accelerator program, did my own incubator accelerator program also, and now full time into this San Angel network. No? Thank you.
Thank you, Sanjay and Shriram. I'm Anup. I come from a technology research marketing background. So the way it is, Shriram is pure finance, Sanjay is a mix of tech and finance, and I am purely in the other side, tech and marketing. So that's how the team is. So this is a series of questions that we have got it asked over a period of, I think, past quite a few months. I thought we will compile all of them together and try and answer some of them. The first one, and I'm referring my notes here, and that gets asked quite often is, how do you typically source potential startup investment opportunities? So how do you get investment opportunities, or how do startups come to you, or how do you find startups? So either of you can take it up. Sanjay, how about you?
Yeah, you want to go first?
So I come from a banking background which was devoid of investment banking. I was a corporate banker. So when I decided to move away from my corporate life, so the first thing that I would do, would be in a comfort zone. Typically in 2015, about 6 months after, a couple of months after I had moved out of the banking assignment, I had to, I learned the hard way how to get into startup investing. Typically, most times, the first thing area where you would get into startups would be family and friends. It was no different for me. A friend of mine moved into the startup space. He wanted to have his own startup, and he wanted me to fund it. That's how I started my journey. Again, if you look at it, there was no thesis. I was naive, raw. The startup ecosystem was not this developed as it is today. So didn't know too many accelerator programs. I wouldn't say they weren't, but I didn't know too many accelerator or incubator programs or other investors whom I could lean on. That's how my journey started. And typically after about 3 investments, some good, some bad, I realized that a team has to be built. It was not just random family and friends that came into this thing, because it was hardcore money, and startup being such a high rate of failure. We had to figure out what interests you, what you're comfortable with, how you can contribute your time. So either if you're involved too deeply, then you can't do too many startups. So these were some of the things that over a period of time I built up, and over a period of 2-3 years after I had invested a lot of time, personal time in working with these startups, I decided that let's broad this. Again, from my experiences, I started avoiding B2C. Not that the sector is bad, but primarily because you need very deep pockets. And before you raise a substantial amount of money, the startup needs nurturing. It needs a lot of money. Cash flow will be an issue. And my thesis generally didn't allow me to, put money into this because I didn't have deep pockets. So that is one of the reasons why I pivoted to B2B. Again, comfort zone coming from a banking experience. That while sales cycles are longer, stickability, if you're able to deliver, is a criteria that I looked at. Another thing coming from Bangalore, startups typically that are in the tech space were recognized more for funding opportunities by either angels or angel funds or the VCs when I started out. So the first assignment that I did was a B2C. Quickly we pivoted because we realized we won't be able to survive if we didn't pivot. And that is where my personal experience came. It could be a B2B2C now, it could be a D2C. But typically, if it's a very early stage startup, not something that I scout for very vigorously. Unless the metrics that the B2C startup delivers is so good, maybe I would give it a fair thought. Again, coming to revenues, I don't have the bandwidth or the wherewithal to manage very early stage startups. So we look for companies that have stabilized, while the valuation could be slightly higher. But the chances of that the company has come out of that 1 year failure rate is much higher. So that is another area where I look at in terms of investment. And team again could be fourth one again team. But you cannot typically run that with a relevant it to fruition, even if it is failure concerns. So those are some of the things that drove my team, and I started spotting avenues for startup investing.
Sanjay, the same question, but before you answer, either of you can answer. Amandeep had a question here on the stream. Amardeep Kaushal. How do you value a startup which are in pre-revenue stages? Okay, he's also said question is to Sriram.
Okay. So that's precisely the reason why I don't look at pre-revenue stage. Amarjot, right? Amardeep.
Amardeep.
Amardeep, that is precisely the reason why it's so. Entrepreneurs come up with ideas. The idea has to then work towards some fruition in terms of a proof of concept. All these things could typically take anywhere from 6 to 8 months. Again, from proof of concept to a minimum viable product or an MVP stage has to be there. You need to have at least one customer to prove that the proof of concept works and how scalable it becomes. So when you look at value and valuation, absolutely right. It's difficult to value a very, very early stage startup. Valuation is not something that I chase. I'm able to absorb the fact that if somebody is successful, I'm willing to pay that extra valuation premium. But valuing a company at very, very early stage becomes very difficult because there is no data to back it. There is no go-to-market strategy which becomes clear, or success stories could be very limited. Again, if you look at it from the value perspective, the team members, if they've had earlier successes, we look at it to see whether we can add a little bit of value over there. So when I joined, when I invested first in the B2C company, I also de facto drove the finances in terms of compliances, in terms of addressing cash flows, hammering the concept of why cash flow is important than profits, than just showing profits. Paper profits doesn't really make sense. So that is one area where I try to add value to the value of the company.
Thank you, Sriram. Sanjay, over to you. The same question, right? I mean, okay, let's take up a different question. I don't want to. We have 8-9 questions to go, 10 questions to go through, and the audience is asking a bunch of questions. So let's try and go through these. So to you, the question is, can you discuss any specific channel or networks that have been particularly successful for you in finding deals?
Sure. Yeah, and before, I think just on the valuation, we just wanted to let the audience know that in these next couple of weeks, we will have a session just on the valuation of the startups, no? And that time we can discuss more details about different parameters and how we can do different stages of startup and how it gets valued, no? So that just make sure that those who are interested can join whenever we announce it, no, in next couple of weeks. So on coming to on that specific channel, so let me just take a step back and say that I had opportunity to work with a very nascent stage, idea stage engineering project, and which is going into startup stage, to IIT and IISc, where people have got a PhD and they are aspiring that their PhD project can become a on their startup, to incubator accelerator thing, to having a bachelor's in entrepreneurships and then running those things. So and then the revenue base and early stage startup, no. Just on Sen Angels, the way the model is, I think that model is beautifully designed to make sure that we get the right startup and for our investors. And the model is the big part is co-investment. So we ensure that we get startup which has got a co-investment, and that is a preferred channel for us also. So when it's a co-investment, somebody who is leading the round, which few couple of crores kind of thing, and then they are looking for to fill the gap, and that's kind of a startup which is mature, which is got all the right ingredients, and then we get it that opportunity to our angels, no, and that big something which is allowed by our angels, and then most of the time that is preferred channel, no. There are other channels. Obviously, we are also partnering with incubator accelerator programs. We also get now started getting a lot of referrals from our angels, and I particularly pay a lot of attention whenever we get reference from our angels, because if they have invested, that means they have found that startup to be very good and they wanted to refer to the group, because ultimately their reputation is also online. So that's why I prefer that channel also when some angel says that this startup is great, no. And also we also started getting a lot of things from the LinkedIn also. I think there are startups who come back to us. But if I have to answer in one word, what is our most preferred channel is the co-investment partners, and that's where I think we find the most value for our angel investors.
Fantastic summary. Other angel investors. So it's a network. I mean, angel investors know each other typically. It's a small, close-knit network at some level. So the startups tend to be in front of multiple angel investors at the same time, and they refer to each other because you want to pool in money as far as possible and spread the risk also as far as possible. Thank you for that answer, Sanjay. So we have few other questions also. Let me just read them out. Neville asked, he is a drone enthusiast and he's been developing and designing drones for quite a while now. And he wants to start something there, but the initial cost, I mean, I think, let me just give you a little bit of gist of how the drone industry works, especially now that the government is pushing hard for it. You need to have a proof of concept. You need to show this thing flies, right? And prototyping is expensive. It's not very easy. It's not very straightforward, because there are components you need to import. There are components you need to develop, manufacture, and only one prototype may not take off. It may crash, right? So you need to have 10, 12, 13 before it kind of the test happens. So he says about 50 lakhs is what you need at that stage itself, the design development stage itself. How can it happen? What can he do? Is question number one from Neville, right? On similar lines, Sandeep Sharma also asked the question. His question is, early stage businesses that needs fund to become operational, what angel investors expect? So he's giving a specific example, a business that requires funds to become operational. Similar to Neville's example, where it's drone tech. He's saying, what about a business where you need some licenses? And without the licenses, the company cannot start operating. What should they do in that case? So I think both the questions are linked in one level or the other. The operations cannot start before some fund reaches them. So these are pre-revenue startup. In fact, pre-prototype, pre-proof of concept startup itself. So what can they do in that case? So it's a broad question. I know it's nothing to do with angel investments per se.
Yeah, so I think it's whenever there is a technology or something unique and something patentable idea is there. Let's take that first part, correct? What Naval asked, no? Now, in that case, obviously, Startup India Fund. So, Startup India Seed Fund is a very, very good scheme where you can go to some incubator accelerator program, which is kind of recognized by the Startup India, and it's very easy to find if you just Google those things, no? And if you don't have the names, you can ask us, and we'll be able to provide those names also, no? And that's where I think they help you to ensure that you get a Startup India fund. And there are two types of funds are there. One is debt, another is equity. So depending upon, and it's 20 to 50 lakhs. So the range what he's asking, I think it's achievable. There is also state level incentives are there. So now a lot of state competes in the startup space, no? So for example, in Karnataka, I was a jury for Karnataka Elevate 100 program. So there the Karnataka government encourages 100 startups. Every year they give a grant up to 50 lakhs, so anywhere from 30 to 50 lakhs, depending upon your idea and how, and you need to be part of the states. You registered in Karnataka. But similar programs are there across all the states, I'm saying, no? So you need to just do a little bit of research and say whether are there any programs are available in your state, and how you can get advantage of that, no? The third one is if it is a research oriented particular department. So if it's a biotech is there, there's a biotech department grant would be there, no? So again, that's something which you can look at. But the only caveat for all these things is that it's a slightly lengthy process. It's the government ultimately giving money, so they need to make sure that it's going to right hand. So it's a slightly longer process than typically which you will have it, and little bit more laborious, little bit more documentations would be required, no? So that's the one part of answer. Second part, you said that early stage startup registration, how do they get fund, no? And I think that part Sriram answered in his first question, that early stage startup. And I think last time also when we were talking on this webinar a couple of weeks back, I had mentioned that in early stage, idea stage, people fund or people invest on the founders, and typically that is either the founders money or it is friends and family money, and based on that you have to show some traction kind of thing, no? And the angel investment becomes the first institutional or first professional money, first check, no? So that's where the idea is evaluated, traction gets evaluated, and then somebody says, okay, I'm going to invest in this startup, and it looks good kind of thing, no, to me. The founder is good. I think as you move, if you say left to right, left is a idea stage and the right is a very mature startup. The founder, how the good founder is, that get kind of defined with the what result the company is producing, no? So initial stage which company results are not there, founder's credibility is the most important thing. As we move towards right, and then as the more traction comes and you go to series A, series B, you are in having 10 crore, 20 crore, 40 crore, 100 crores revenue. It's kind of it is proven that the founder is good. Now let me look at idea and how this idea is going to evolve in next 4 to 5 years, no? So that becomes more critical than the founder's credibility. Founder credibility is already established by since they reach up to that point, no? Is I can probably give an example that if you come from IIT, the first job is important, but after 30 years, if you ask, I'm IIT, nobody's going to listen to you. What you've done in 30 years is more critical, no? The same thing happens in the startup and the company also, no?
Just adding to that, Anup, see, typically, if at idea stage, Sandeep, it's very, very critical. Sanjay rightly mentioned that the founder's credibility is in place. So again, another thing that I look at is, we tend to avoid solopreneurs. We need to have co-founders. That's a very critical aspect. primarily because you need to have depth and diversity in the team. Two, at least to start with, three, if as and when it matures. And typically, tech has to be in-house. So you need to have somebody who's a tech person, being a co-founder, because like drone, like Neville mentioned, drone. It's very, very, very narrow. The technology needs to be at that level where you need to have things in-house and control. So if I had a tech person who's where I'm outsourcing it, then that is not something which an investor would look at. It would typically need the founder's contribution as well as support from what Startup India and the other avenues that Sanjay mentioned. So that is where getting a then figuring out what all things you tick accordingly from an investor perspective to show it is investable. So again, the second round is when the idea is established, the market size is known, you've got customers. So till then, it's a fight. You have to be bootstrapped.
Okay. So again, a few more questions coming in. I think I'll take up a couple more questions from our list, but let's focus on the audience questions a little more. Okay. So Neville says, Startup India, Elevate, the criterias are very tedious and impossible. Of course, we can't help it now, right? Beyond a certain stage, you have to seek fund from people who are willing to give you funds and that's a huge risk capital, right? It could completely fail. So you have to meet their criteria. There's nothing much to be said about it.
Yeah, and I put it mildly that it is laborious and it is the documentation is there.
Yeah.
So
it will. I mean, people will want a lot more proof. When they are putting money and they know that it will vanish, it will just disappear because failure rate is so high. Sandeep kind of followed up saying, license acquisition cost is 2.5 crores. Incubation doesn't supply that kind of fund. I think, Sandeep, you need to tell us what this business is, which requires 2.5 crores of licensing cost, because it doesn't look like a startup. It seems like an established kind of a business where you are trying to enter that business. It's not a startup. It's not something new that you're trying to do. Please tell us more about it so that we can give you some more insight rather than, just trying to talk in general terms. Sure. There are a couple more. Ashley Martis, he's from US. I've spoken to him earlier. Hi, Ashley. Thanks for joining. So Ashley does a few things, right? He's been in the VC industry for quite a while now. He started when he was 17. So he's a venture partner from Canada, US, looking to help turn successful Indian angel raise a fund and turn themselves into a VC. So he's asking SAN angels or individual angels, will this be a career path for them to become a VC? Would that be of interest?
Of course.
Of course, yeah. So I think Ashley.
But let me just elaborate a little bit. I think the way we are looking at this is that we understand. I think we are just about a little bit more than a year old kind of thing. So first thing first is like we need to understand the startup ecosystem, and that's why we have built this angel network. And while building angel network, we build that the risk is minimum. That's why we put it co-investment, other things, correct? As we grow as a network, and I think currently last year beginning we were about 70 people. Now we are about 360. So roughly we added about 300 in 1 year. But as we grow bigger, obviously we need to make sure that we can take a bigger bet also. And when we want to take a bigger bet, we need to also follow path of angel network to angel fund to VC kind of thing. No, right now we are partnering with those entities to get the right startup. And how do we get benefit out of it? Is that many times there is a bridge funding is required, or startup is looking for a couple of $1 million, and then they are struggling to get a crore or 2 crores. That's about 10 million rupees. I just want to make sure that Ashley understands that. And to close the round. and that is where I think we feel that it's a sweet spot is there, no? Because those are the rounds where almost 100 million plus rupees is already been invested, and they are only looking for another 10% to close the round. And for us, nothing can be better than that kind of thing. So we look at those kind of opportunity as of now. But as we grow bigger, we know that we may not get that many opportunity in that space, so that we can get all our angel to invest it. So we need to take a bigger bet and bigger ticket size, and that's where we will go for angel fund and VC. But yeah, definitely that is something in our roadmap. It's just a question of time, no?
Also, just to add to that, Neville and Ashley, the kind of uh, laborious things that you were talking about, earlier that Sanjay mentioned, even getting your licenses cleared for angel funding as well as for venture capitalists is a tedious process. So one has to be patient. One has to prove their credentials. One has to have managed successful startup investments, worked with a network. So it's a step-by-step process. And that is where we look for more like-minded people so that you can move a couple of steps uh, faster than what others could or what we could have planned earlier. But yeah,
Yeah.
it's a step in itself.
And just to add one quick point on this, that one of the thing which we would like to do in the timing is that if there are any VCs are there who wants to look at the startup at early stage, observe it for about a year or 2 years, and in next round they want to come as a bigger round. That's a kind of a space where it's a great collaboration opportunity, you know. So, for example, there are 10 startups which we bring on the platform, and then VC invests about 100K, correct, dollars, and that's not a big money for VC. But out of 10 startups in 2 to 3 years, 3 or 4 startup is really a big star which they are emerging, no, and they get right of first refusal in the contract while they have got this 100K, and then they can invest $3 to $4 million. I think that's a win-win for the angel network also and for the VC also. So that's the kind of opportunity. That's the kind of partnership that we look for. No, you are on mute, Anup.
Yeah.
So thank you for answering that. There was another question which Kaustubh had asked. What's the minimum quantum of investment that interests you? What is the typical ticket size? At what level of revenue or profit do you like to come in? I think we have already answered that question, right? I mean, thank you so much for that. Going back to all the questions that have accumulated, over the months. So how do you assess the market opportunity of a potential investment, and what factors do you consider? So let's keep it short. I mean, it's already half an hour has passed, so let's try and give some variables and some criteria that we look at. Sanjay, you can start.
Okay, you want me to go? Okay, so I think for me, one is a market opportunity, another is the angel's preference. So I do look at what our angel network wants, no. So if there are angel, recently we were asked that, okay, can I get some healthcare startup, no? So we said, okay, we'll try to find a healthcare startup, no? So we are sector agnostic, but we also listen to our angels very carefully. So that's one part of it, no? Uh, and that's where I think we also look at market opportunity, how we come. In terms of how we evaluate the market opportunities and other things, I think I call it a 4T model. The first is a team or the founders, how they are gelling well, what kind of experience they bring, what is their past success rate, have they got a startup experience or not, have they coming out from the bigger organizations or they're coming out of the college. That's the one part of it, no? And then the team dynamics, is there somebody is dominating, or are people are working collaboratively, is the experience is diverse or not diverse. Siram touched on that solopreneur. There's another thing is husband wife team, brothers team. Those are the something which probably we look at it and think about it, that what happens if suppose we hope that nothing happens, but there is a personal level of conflicts are there. Would it come into the startup world or not? No. So those are one from the team perspective. No. Another is then traction, correct? as I said, we look at a revenue-based startup. So we look at it, is there a hockey sticks approach emerging or not? No, it will not be complete hockey stick because we are still, it's quite early stage pre-series A kind of thing. But yeah, over a period of last 6 months to 1 year, how do we see? Is this like a revenue is flat or revenue is growing rapidly and it looks like that it's going to break out and then grow more rapidly or not? No, that's the second part, correct? The third part is the TAM. What is the addressable market? Is it a big enough to for our investor? Because remember that investor is going to get their money back only after 3 to 4 years. If market is small, they are not going to they are going to flat out in the revenue pretty soon in their life cycle. And if that happens, they very unlikely that investors will get exit. So this also very critical that we look at the TAM part of it, no? And the last part is, and then it could be exception also that in some cases we have not looked at it, but in general, how they are using the technology, no? Because technology is an enabler for all the things I said earlier, correct? And all of these are intertwined, correct? It's not that one is different. If the founders or team is good, obviously traction may most likely to be good, correct? If traction is good, that means the technology also that we are putting is going to be good, no? So everything is intertwined, but we look at this 4Ts model and then we'll see whether how beautifully it works in each startup before we bring it to our angels, no?
I just like to add, so typically every entrepreneur, founder of startups, when they come up with ideas, they feel it's new. Every idea they feel is different. So we try and see whether it really makes a difference or is it an also ran. So today, if somebody came and said, I did something in the logistics space, which Swiggy and Zomato were not able to do it, I would look at it differently. Somebody said, I'm doing something in the Ola Uber space, I would look at it very differently because already established players are there. A lot of funding has gone into it. Markets have already been addressed. So how new could that idea be? So that's something that we look at very, very closely. It can't be an also ran, or it can't be a third, fourth, fifth tier type of companies. Because then by the time the companies which are on the top level would have moved into an SME kind of a segment, raised more money, gone and listed in the stock bourses. Another thing that we look at very, very closely is the idea patentable? Again, when it comes to drone, when it comes to very, very high technology, AI, ML thing, patent is something that we closely look at because that's something which can protect the company, at least in their initial 1 or 2 years of the journey. It puts a stop to the competition in trying to copy that. So that's something that we look at. Other than all these things, we also look at the entry barriers. How quickly can somebody who has money, deep pockets, if they knew that you were successful, they can easily enter by hiring professionals, pouring money. Is your idea, Sanjay said, TAM, technology, team. The main thing that differentiates is entry barriers. How this startup can avoid competition at very, very early stage. Those are some of the things that I wanted to add.
One thing I think both of you did not touch up, and I look at it typically because I have a background in IP as well as marketing. Yes, Sriram, you're right. I mean, IP, at least for the short term, definitely gives a barrier to entry, especially if it's a very specific technology that you're looking at. It also can hamper, sometimes startups kind of fall into that, oh, I have created something great, I'm going to get a patent, therefore let me not pivot here and there. You have to pivot based on the market. That's the second piece I look at. How fast are you looking at the market? I mean, many startups are very technology centric. They want to develop the technology. It's a sweet spot. It's very comfortable. They forget that they have to rapidly accelerate and get into the market as far as possible and try and acquire customer, at least get in front of customers. Acquisition may still take time, which is marketing, nothing else, right? So innovation is one part and marketing is the other part of it. Peter Drucker said that, a company, only two things a company should do: innovate and market. So the marketing piece, I see many people kind of do it as a hygiene factor. It's, oh, it is to be done. I'm doing something on digital. There is a LinkedIn thing running somewhere. Somebody else is doing some cute looking posts on my Instagram. That's not marketing. You really need to have an approach to market which tells us that, within a year, you are able to accelerate and grab more of the market. Because as you rightly said, Sriram, somebody else can come along with deeper pockets, put in the resources, tweak the technology a little bit, or come up with a bad technology, even worse technology than what you have, and grab the market because they have that money in hand, and if you do not have the plan to get in front of more customers, that's a big red flag, actually. When you're looking at an opportunity, and if the market penetration is something which is very, very difficult, like you're only going to work with the government, very, very tricky. Thank you for answering. Next one is, I think we have done this multiple times. Can you share a story about a particularly successful or challenging investment that you made and what you learned from that experience? Sanjay's story and Sriram.
So let me share one of the success stories. Yeah. So this is a last quarter of 2022. We got a startup which is in the pure agri play kind of thing, no, not agri tech, pure agri, no. And the first reaction was that this is not a startup which will give us a 10x return kind of thing, and then let's give a pass kind of thing, no. But since it was a very good idea and it was having a very good traction also, and then something interesting they were doing in the agriculture thing without technology, and so we say, okay, let's talk with the founder. So we spoke with the founder. Founder is coming from the very prestigious MBA from USA, worked for about 10-15 years in that space, in agri space also, sustainable space. So that kind of impressed us. And then we told him very clearly that we don't find that this is going to be investable opportunity for our angels. No? And that time we said we need to do something different, very, very different than what usual stuff we do. If you're open to that, to explore that possibility, then we can talk about it. No, so he was open, and then we came out with a structure which at least I have not seen in a startup world, that kind of a structure where it takes the currency risk away from the foreign investors. It gives some guarantee return on the equity, and it also gives, if you want to give an option to go to regular stuff where you want to also become shareholders after as a regular equity shareholder, that also option was given to the investors, no. And to our surprise, I think we got the maximum response in that particular company, which we were not expect. Earlier, we were expecting we may not get one. We got lots of response, and then one point in time, it kind of the soft commitment touched very close to 2 crore. No, so obviously the hard commitment was little less, and typically that happens in any. It was not. It was still the top for us. No, so it was a very learning experience for us that if we apply our mind and we look at innovative solutions, I think there is some solution can come up if a startup is good, no, and if they have a good story to tell, no, with constraints also.
So yeah, again, I keep adding to what Sanjay keeps saying. See, again, when the amount that was needed by the startup was significantly higher, this had to go to a venture capital kind of concern for further fundraise, right? And very clearly it came out that these guys had to do something on the tech space. Otherwise, they asked, how do we exit? We'll put in the money. You'll give us the top line, you'll give us a good bottom line, but how do we exit? So tech is very, very critical. And that is where, the openness of the founders and the CEO of the company, where they're working in preparing a blueprint. Again, Sanjay has been working with them and seeing how they can bring tech as a play and not just as a tool. So sometimes what we feel, tech aa gaya, that's not what we look at. We see how tech can really enable growth and not just aid as a CRM or a backend tool, which we think technology can do. It can do much more, and that is what VCs look at, and that is where Sanjay has handheld worked with them, drawing up blueprint for technology.
So the next set of questions are around how do you network? How do you approach building relationships with founders, other investors, industry experts? And the primary criteria, the primary reason being, you want to identify more potential opportunities. How do you go about doing that? Any tips and tricks would be great. This would be great for new angel investors, who are just getting started with the startup ecosystem.
I think Sriram is great in network, so Sriram should go first.
Yeah. Sriram, over.
So again, as I told you, 2015 was a very, very tough year for me in terms of investments in startups because I had absolutely no clue, right? And once I started investing, I started meeting with other potential investors, potential guys who are getting into incubation. I started understanding what an accelerator program was, started getting into investment committees to figure out what happens on the other side. So those were some of the things. It took me about 3-4 years. I had to do everything from scratch, all by myself. And today, the network has built because I have personally gone, visited people, whether it's an incubation, whether it's an acceleration program, whether it is these are individual investors, went and met with VCs for larger fundraisers, tried to build my network because I didn't come from the investment banking industry. So everything had to be built from scratch. And today, if somebody has to start new, the tough way to do it is doing everything yourself. But platforms like ours, you get to understand, you get a feel, you get introduced to terminologies. So when I moved into this, I didn't know what a TAM, SAM, SOM was. So I would tell the startup, hey, listen, you have to tell me what these things are. So some startups could think, hey, this fellow doesn't know even these basic things, right? So you have to be prepared to accept that, and this is a learning process and you grow along with it as a new investor. If I didn't know, I didn't know. So be open about it. And that is where the network comes into play, because one, you can either get information. I think San Angels, we did briefly talk about, terminologies in the startup, what these mean. And apart from that, somebody wanted to know, what a startup is all about. How do you go about evaluating it? So we tell them, come join the group. You don't have to invest necessarily initially. Look at what happens. Learn. When you're comfortable, talk to people. Say, hey, listen, this is my level of interest. This is my level of risk appetite. Do you think this is something which which I should do? Baby steps. That's the only way that you can take. And today you have a lot of ecosystem which supports. So you can get onto VC platforms. You can get onto angel fund platforms. You can get onto angel networks. So find the right fit where you feel. So if you're new and want to learn, maybe a VC firm may not have that kind of appetite to train new investors. So get into a platform where you're comfortable and where you can learn. And so that even if you burn initially, the burn is not significant, or as a part of process, you realize, yes, you need to go through fire before you hit the right spots. Again, how within a group, investors interact, what typically you learn from there, as well as in terms of co-investing. If an investor has invested in a startup and he wants this company to raise further money, he gets into the network and says, hey, listen, I have this startup where I have invested in. Would you can you look at it? So the investing group then starts looking at the proposal also differently, right? So what the individual investor could have missed gets covered. It could be late, it could be early, or it could be investable. So you learn a lot of things as you go along. So the group that you interact with, some of them could even get into mentoring, form a basis for mentoring. Very, very early stage startups would look at that. Get into the field, get a feel of the ecosystem, and then you start investing.
Thanks, Sriram. Thanks for that answer. And it's a lot of work too. It's not as simple as, just getting on a Zoom call. You really have to meet people, and they need to trust you. You need to trust them, understand them. So it takes time. It takes effort. It is work. It is network. Yeah, at the end of the day, it is not all armchair guessing. So yes, you have to put in a lot of effort to build that right network, and the right network, because there are money being money, finance industry, or even funding industry carries with it a lot of shady characters, as usual.
That's true.
Yeah, I'll just put a couple of points here. So one is, I think, for the budding entrepreneur, the forum like TiE chapter in their town, if it is available, I think it's a good forum to interact with other entrepreneurs and angels and other ecosystem players also. No, it's a good starting point for those who are just new to the ecosystem and just want to see how that ecosystem operates. No, so TiE is the one which is a non-profit organization, and they do a good job in that. No. But apart from that, I think it's a continuous process. It's not a day one, tomorrow you will have lots of network. No, it's a hard process which builds over a period of time. No, so you need to give that time. You need to make sure that you are talking to more and more people. It's very critical. And the third point is that sometimes what we feel network and relationship is just to take, that I want something, I want funding, I want this, I want that. So that's why I want to build network. No, network is more about giving. Start giving something to the people, and people will start asking you what you need, kind of thing. No, I think you don't need to approach them also. No, that's a big learning which I have. I think it's something which everybody has to look into it and say that, do I giving enough in my relationship or network before I ask something. No, and the last thing which I learned, like, since I kind of have more gray hair, so over a period of time I have built good network in technology and other areas, and I was reluctant to talk more about what I am doing currently, kind of thing. No, and when I started talking about, I kind of realized that so many people were interested in what I am doing, and they were ready to come and join as an angel or other things, which I was earlier with. I was very reluctant to talk to people about what I am doing unless they ask for me. So I think once you build a network, talk at least what you do. Not that you need to ask you what help you need, but at least say, okay, I am doing this, so people are aware about it, and if they are interested, they can approach you. No, so that's a few things, with a few thoughts which I had. No.
Also, that is how networking happens, right? I mean, you're at the airport, you say what you do. Who knows? The second guy could be a startup founder, the third guy could be an investor, the fourth guy could be a VC. So you never know. Opportunities are always there. You just need to pick the right ones.
Yeah.
So I mean, there are a lot of questions coming, and some of them are valuation related. I think we will answer those when we do the valuation session, right? Okay, final question from the list we have. How do you stay informed and up to date on industry trends and emerging technologies that may present new investment opportunities? And I think that's very, very valid and important for investors. Sriram, you can start.
Yeah. So typically, coming from a banking industry, I have had access to reports for industry references. So that's one basic area I look at. Number two, the reason why we go into co-investing currently is because we don't have that depth of knowledge for industry or for, to validate what could be the correct market size or, what competition could be. So while we have teams, there's a lot of work that goes into that in terms of identifying uh, what whether suppose it's agri business, agri tech. Does governmental policies make a difference? Drones, which are very, very specific, where you may need some kind of approvals. I think Sandeep mentioned licensing. So I don't know what thing, but the licensing could be critical because uh, you need to have governmental clearances. Take solar with imports from China being curbed for solar panels, import duties being very, very hard. Uh, does it affect? So all those things you need to have uh, either a team working on it, or you need to be co-investing where you challenge the other guys, you ask these questions in when you're meeting up with startups. So these are some of the things that you need to necessarily invest in. We also have industry experts. So while I may be a generalist coming from a banking background, not specifically a sector specialist, take a healthcare space. If you have a doctor, or if you had people from professional, uh, you know, people from healthcare profession uh, as investors on your platform, make use of their uh, you know, get their information, use their talent, figure out how they would view it, have them on calls. That's how you get information you build. And when you build something, it goes into your database. So next time when somebody in the healthcare space, not necessarily what you would have done, comes in, you should be able to relate. See if the industry parameters can be applied over there, or is it different? So that's how you build on your industry reports. So there are reports from CRISIL, there are reports from, if you're looking at it globally, somebody says, hey, listen, my startup is not restricted only to India, it could be Southeast Asia. So get reports which are Southeast Asia oriented, work on them. Again, valuation. How do you apply valuation? While we'll be talking about this in the future thing, it all boils down to what the industry is, what size it is, what kind of margins it allows, what kind of interferences are there. So that is where it becomes critical. One, doing things, the homework that I would do when I meet with startups, and having my network, which I can fully use. Third reports and other
I think we are losing Sriram.
platforms where you can will be there.
I believe Sriram is having some network issue. So Sanjay, over to you. How do you keep up to date with industry trends and emerging technologies? So before you answer that, there is another question by Rajneesh Singh. Early stage startup investments don't seem to deliver high returns vis-a-vis the higher risk as compared to small cap listed companies. So what would be the incentives to invest in startups? So I think there is an assumption and then an option, right? So over to you, Sanjay. You're muted. Please unmute yourself.
Yeah, I think Shriram elaborately gave answer to the previous question, but I'll just add one more point. For me, the biggest learning happens when I talk with startup. No, so last year we had 130 startup with which we spoke, and out of that we selected 10 startup. I think once you do that kind of thing, you pretty much know that how the industry is going, how the new startups are emerging, and what come. Apart from that, obviously there are a lot of avenues are there which Sriram mentioned, and obviously that's one area where we can also get a lot of information. Sriram does a wonderful thing for us internally where every day morning we get snapshot of all the startup which got funded for that particular day or previous week. And if you look at collectively over a period of time of 30, 40 days, you pretty much know that what kind of startups are getting funded, no? And that also tells you industry trend. So these two things for me, I think it is really worked well, no? Now coming to the next question, which you Anup talked about, is about very early stage startup, which is what is a small cap
I'll
fund, correct?
repeat the question. I'll repeat the question. Early stage startup investments don't seem to deliver higher returns vis-a-vis the higher risk as compared to small cap listed companies. So what could be the incentives to invest in startups?
Okay. Now, I think that's a myth in my opinion. Obviously, one thing which I will consider that early stage startup has got more risk compared to the small cap, because small cap would at least have got good revenue. That's why they are in the listed companies, no? But if in small cap also, if you start investing in randomly without looking at the company, it's going to be a higher risk compared to the large cap, correct? That it's kind of always goes that way. So same. So for early stage, obviously you need to do a little bit more digging. Look at the founder. As founder becomes very critical. Is he a hustler? Is he, can he get going, because company is going to get challenged, correct? And if he, in that challenge, if the startup founder gets bogged down, then it's going to be a problem. The second thing is, while it is higher risk, always if you are going to invest only in one or two startup, my sincere advice to whether early stage or late stage, please don't invest in startup ecosystem, no, because startup ecosystem is a risky asset class, and that you take care of risk apart from doing all the due diligence and making sure that founder is good, TAM is good, and what I talked about 40. Still, the risk of failure is high, because startup gets the statistics says 9 out of 10 startup fail, correct? The only way, the other way you can do it is that you do a portfolio. So when you are investing, make sure that you invest in a basket of startups. Very good valuation, and you can get substantial equity, and then good kind of in subsequent round, correct? Invest in that same startup. If suppose if you invested in the portfolio, you are doing portfolio, so you are investing in 15 to 20 startups, a small amount, so that way your risk gets diversified. Second thing you can do is that out of those 15 to 20 startups, say 5 startup comes as a hero startups, I call, kind of, which looks very promising in couple of years, and then they got another round. That time, even though it's like slightly higher valuation, invest some more money into that, no? Now that out of that 5 to 10 startup, maybe another one or two will go further ahead in the game, no? So maybe you can invest in second time, no? So that way, if you do a gradual, maybe you can call it an SIP or systematic investment plan in a different way. In mutual fund, it is kind of monthly, but here is a different way. In the round wise, we are doing SIP, no, at different valuation. That can substantially reduce your risk, and you potentially can come with a winner with a higher percentage of equity in that winner, no? Shriram, you are mute.
Yeah. So adding to that, Rajneesh, typically small cap returns again are percentage wise, not necessarily times wise. Whereas if you look at it from a startup perspective, higher the risk, higher the return is there basically because you typically exit at 2 to 3 times, starting from 2 to 3 times to about 6 to 7 times, depending on the time horizon, whether it is 1 year to 4, 5 years. Whereas small cap, being a listed entity, the growth, while it is better than large cap, again, it does not, it's again percentage wise. So I think somewhere, that's where the difference lies in the risk return reward. And again, early stage, very early stage is something where you need to physically put a lot of time to ensure that the startup stands up in terms of weathering its existence in the first year. But if you look at slightly matured startups, which are in the 2 crore to 5 crore revenue, whether it is GMV or whether it is pure revenue. These are companies where they have crossed the first barrier, and the stage that they're looking for is growth, not survival. So again, as the risk reduces because they have survived that period, the returns will not be 8-9 times. Maybe it would be anywhere from 2 to 5 times, 6 times. So that gets factored. That is where I think one needs to be know what sector that they're comfortable with, like how you do a portfolio read in your small cap investments.
One last thing I do want to add is when you invest in the stock market, the information is filtered at multiple levels. It's second-hand, third-hand information which is coming to you. The company communicates to you maybe 4 times in a year, right? And that too, there is a lot of accounting magic that happens in between, financial engineering as they call it. So really to dig in deep to actual day-to-day operation, you have to go and visit the company, and you're not going to be entertained there that easily. But in case of startups, the information is pretty much firsthand. You are talking to the founders, their plans, the strategy, the pivots, what they are facing. The money is involved many a times. I mean, there's a board seat involved if the money is large enough. So what is happening on the startup. So when you think of risk is today one of the factors of risk is information or lack thereof. When you have all the information in hand and you can evaluate the market yourself, the risk reduces. Is it inherently risky? Of course it is. I mean, all investments are. There are no, risk-free investments. But how much knowledge, information, and transparency is there in the investment that you're making matters a lot. And in that case, startups would be at the top of the pyramid, where you have a lot of transparency, you have a lot of information. Of course, I'm not saying at VC level investments in information and transparency may not be there because the companies are larger, and we are seeing a lot of issues there too. But I hope we have answered your question, Rajneesh. Thank you, Sriram. Thank you, Sanjay, for joining and spending time and helping us do a wonderful session today. So many good questions, good answers. We've already crossed our 1 hour mark. We wanted to keep it to 1 hour, but we have crossed it. Let's continue this discussion next week again, and hopefully we can do something on valuation, startup valuation relatively soon, and bring in a few experts and have a chat with them. Thank you.
Yeah, I think also, Anup, next week we would like to do a specific session on India startup ecosystem, so that people who are not in India, who want to look at how the Indian startup ecosystem works, we can have one session probably next week on that. So that will be very useful for everyone who are not in India but want to understand it and interesting.
Perfect. Thank you, Sriram. Thank you, Sanjay.
Thanks.
So let's wrap up the session now.
Thanks.
Bye.
Thanks, Sanjay. Bye. Thanks, everybody. Bye.